You see price action like this. It's going down consistently. Can you say what the price will do next? At this stage you can expect one of the three things to happen. Either the price goes up, the price consolidates and moves sideways, or it keeps going down. But how can you tell? Your general perception of the stock market tells you that the price must take a bullish turn, but how can you be sure? Is there a way you can tell when the price might reverse? In this video, we are going to talk about how you can find out when a trend is losing steam and when it is about to make a U-turn. So, if you're interested, please watch till the end and subscribe to the channel to learn more about trading strategy and indicators. As you know, the market does not move in a straight line. The price is always moving up and down. Although at a granular level, the price movement does seem random, but if you zoom out, you will see the price does follow a general trend. It is important to always trade with trends. But the trend does not go on forever. Eventually the trend will end and the price will trend in the opposite direction. So, if you missed a trend, how can you tell when the trend will reverse and catch the next one? In trading, a price reversal occurs when the price of an asset changes direction after a sustained uptrend or downtrend. It is important to check the sustainability of the trend. It is hard to predict reversal in a short period. Although it can be hard to predict the exact moment of a price reversal, there are various technical analysis tools and indicators that can help you find the pattern. Some of them are the support and resistance levels, candlestick patterns, and volumes. But one of the better indicators that we are going to talk about is called divergence. Divergence is a concept used in technical analysis to identify potential trend reversals or trend strength in the price of an asset. It occurs when the price of an asset moves in a different direction than a related technical indicator. This discrepancy between the price action and the indicator can provide valuable insights into the underlying market dynamics. But what indicator you should use to find the divergence? There is a lot of such indicators, but any momentum indicator can be used. In our case, we are going to use the Relative Strength Index, or RSI. In technical analysis, RSI is used to measure the speed and change of price movements. As you already know, RSI is mainly used to identify the overbought and oversold regions, but we will not focus on those for the divergence strategy. Now that we have the RSI set up, let's look for a divergence. All we are looking for is a price movement that is different than the RSI movement. As you can see here, the price is making lower lows, but the RSI is making higher lows. This is a divergence. All this means that the market downtrend is losing steam and the price reversal is coming. One of the important things to notice here is that when the price is making lower lows, the drop is gradually shrinking. Meaning the bears of the market are losing the momentum on pushing the price too low each time. At some point, the price must reverse, and that you can see through the RSI divergence line. We mentioned before that the price may not just shoot up from a sustained downtrend. Price may move sideways before it moves up. Or worse, after some sideways movements, the price may drop again. So how can you tell if the price reversal is genuine? To find that out, you need to find the overall market trend. And for that, we need another indicator called an exponential moving average, or EMA. The moving average line shows the trend in the market. The period of the EMA is important since it gives you the information of the moving average period. If you choose a short period, the moving average will be choppy and will not provide an indication of a general market trend in a long term. Too long a period can also be misleading for swing trading. So, for this strategy, we will be using an exponential moving average of length 50. If the price is moving above the EMA line, then the market is in an uptrend, and if the price is below the 50 EMA line, then the market is in a downtrend. As you know, in trading, the trend is your friend. So, we should never take a long trade when the price is in a downtrend or below the EMA line, and never take a short trade when the price is in an uptrend or above the EMA line. Now that we have both our indicators set, we can look forward to making a trade. This strategy works better if you use a relatively higher time frame. The principle is the same for lower time frame as well, but it is difficult to time the market in a lower time frame. So, for a long trade, first we look for a sustained long downtrend. Then we look at the RSI, and if the RSI is making higher lows, then it's an indication of a divergence. Next, we wait for the price to move above the 50-period EMA line. This indicates the trend has reversed. You can take a long trade at this point. The idea is exactly the same for a short trade, but the opposite. We look for a sustained uptrend and wait for the market to lose bullish momentum. The RSI should make lower highs, which indicates the divergence from the price action. And once the price moves below the EMA line, we can open a short trade. Here are a few more examples of how you can use divergence to make profitable trades. You should remember that predicting price reversal is very difficult. It is almost like timing the market, which we all know is difficult to do. Apart from these technical indicators, prices can reverse based on economic news or public sentiment, none of which can be analyzed with any technical indicators. So, you should be careful when trading divergence strategy and incorporate additional factors into your trading on top of these indicators. I hope this video was useful. If you enjoyed this video, please leave a like and share this video. Subscribe to the channel if you want to see more videos like this. Thank you for watching.